across the ocean. It's more than just a goddess. We all need one another. Oh, oh. Ba-da-da-ba-ba-da-dee. Ba-da-da-ba-ba-da-dee. I'll be waiting for you. For you, you, and you. Oh, 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 oh.
Good evening, everyone, and welcome to today's broadcast of Real Estate 101. My name is Uche Okugo, and on behalf of Real Estate, she's a real estate agent, sales representative with REMAX, the largest real estate firm in Canada. She's also the CEO of Diamond Trust Properties, a real estate investment company, also based here in the GTA area of Ontario. Deborah has been a real estate investor and a speaker. She's passionate and committed to helping people own homes and also invest in properties in Canada to create sustainable wealth. And like we know, that's one of the ways to actually create sustainable wealth. Throughout her career, she has helped countless people retire comfortably, helped young families realize their dreams of home ownership, and also managed investment portfolios for investors both locally and internationally. Once again, it's my honor to introduce and welcome Deborah Ojo. And I enjoin you all to sit back, listen, tune in. You can keep your questions, gather them, and send them as the program goes on. And do enjoy today's presentation. Thank you very much.
Okay, thank you so much, Uche. And right now, I'll link up with Deborah Ojo. Please, everybody, hold on. Thank you very much.
Africa rapper number one. Africa rapper number one. Emma, you microphone magician. Oh. Everybody put on
yes, and they say I'm the best. I'm on top of the rest. Cash is clear what I do to the list.
Okay, madam, I'll be bringing you up in like 2 minutes. Okay. We have Deborah Ojo here, and I believe we are ready to proceed. The floor is yours, or the screen is yours.
Thank you so much, Sam. Thank you so much, Uche, for the introduction. Thank you so much to our viewers. I want to take this opportunity to thank all the members of the Network of Nigerians in Canada, and also especially to the coordinators for bringing this wonderful and fantastic initiative. I just need to post to YouTube on my own side. Just give me, where is it? I'm hearing myself talk back. Okay, so thank you very much, guys. Sorry for I'm trying to coordinate myself here. So thank you so much for the viewers. I got a lot of the questions that you guys had. There was a lot of questions. I'm going to try my best to answer almost all the questions, but if I'm not able to answer any of the questions, please feel free to message me or reach out to Uche, or also get my information from the coordinators of this event. I'm still trying to, I can hear myself talk back. Sam. Yeah. Uh, Okay. Yes, it's fine now. So let's grab a cup of coffee, water, whatever makes you feel comfortable as we dig into Real Estate 101, sponsored by the Nigerians, as the Network of Nigerians Association in Canada. So a lot of people, I got some few questions. So I'll try to answer your question with each of my slide. So I got a question about there's so much investment opportunities. Why should I even bother about real estate? And I wanted to use this book that I read. It's called U Square. So if you've read this book, please comment in the description or in the link below if you've read this book. But this book was talking about how you don't have to work harder sometimes to achieve your goals, but you can work and try to quadruple or make your efforts to be exponential. So instead of saying I want to work harder or get more shifts to better myself financially, what other things can I do to make my efforts instead of making $100,000, make it maybe I can make $100,000 square. So and that's what real estate does. So a company like or a company like McDonald's was not just a burger flipping company. They were owning the best commercial real estate around the world, and once they get a franchise in place, the owner of the franchise, of course, will pay the mortgage down for them because they're renting it from them or leasing it from them, and they pay this down, but also the value of the building is growing. So they are making money on the franchise aspects. They are making money on the burger business itself, and they are also making most of their money from the real estate. Because real estate, I was an example as an immigrant when I first came to Canada, and I was trying to make my first $100,000 or even make my first $1 million, and I was trying to research, and it didn't click for a while, but when it clicked, between 2 years, we put $25,000 down into our property, and within less than 2 years, we were able to make $300,000. So that's exponential growth, and that's what real estate can do for you. So there are different portfolios, whether it is GIC or other things that the bank offers. But what I typically say to my clients is you need to know what portfolio and why you're having it. So for the long-term goal, you might have real estate. For your emergency funds, you might put it in GIC because that is you can easily turn that to liquid cash. Okay, so that's why for me real estate is the big thing that I love real estate. Another reason for real estate is, do you know that 45 a homeowner's network is 45 times greater than a rental? I want this to sink in for a minute. So you're putting money back into your landlord's pockets, right? The landlord is paying their own mortgage, they are paying it down, and also the property is increasing in value. So even if nothing else, the fact that maybe you put $12,000 into your landlord's pockets per year, maybe you live there for the next 5 years, multiply, so 12,000 multiplied by 5 years, at least even if the property didn't go up in value, you know that your landlord is getting this amount in his pockets when they decide to walk away from the property. And also, I got a few questions to ask me about what is going on in the markets. Is it a good time to buy or not? So I'm going to answer this question as well with statistics. And I'll try to see if I can share my screen with Sam right now. Sam, can you? Okay. Yeah, I'm sharing my screen with Sam right now. Whenever it's ready, I guess, it will bring it up. But huh? Okay. Okay. So in August 2019, there was uh, there was a sale of 5,483 homes that was sold in August of 2018. In August of 2019, we sold 6,094 houses. So, and this is all, by the way, Pure Region statistics, because I work mostly in Pure, so I was just sharing this information with you. But my point of bringing the stats is to show how we performed in the market last year, despite the speculations, and now we are performing already this year. So with this statistics, you can see, according to Toronto Real Estate Board that governs us here in Ontario, you can see that we've sold at least 500 homes more than what we sold last year. So what this is telling us is yes, there's speculations, there's all those things, but the market is still progressing. There are a lot of immigrants coming in. There's a lot of students coming in also to come and live in Canada. Canada is one of the most attractive places where everybody all over the world wants to live in. And I was also talking with my colleague at work, and we were talking about the markets and everything. And it was reminding me of New York, places like New York, places like Europe, how much on average the cost of their homes are. The ones in condo in downtown Toronto right now, maybe around $800,000 on average. In New York, it's about $3 million on average. So our market is still mirroring those kind of markets. So we keep growing, and that's the evidence. The next statistics was showing that in August of 2018, we sold an average home was sold for $683,000. And this year now we're selling that same house. The average is selling for $743,000. So again, this is to show you that from last year to this year, if you had put $25,000 away, at least you will be clearing at least maybe $60,000 in profits ROI. That means your investment has doubled up. So I come from the school of thought of an investor. So I'm an investor as well. So whenever I'm giving you a scenario or I'm explaining things, sometimes I'm coming from that point of view. So I am looking at it as a first-time buyer, yes, but also house is an investment. Now let's talk about another indicator of whether or not it's still a perfect market and when we should buy and all of those good stuff. Another one thing that we look at is called months of inventory. So right now it is seller's markets because the inventory we have right now is below 4 months. It's taking on average between, I would say sometimes I even sell a house within a day right now. So right now an average is about 30 days days on market for the property to get sold. So in this kind of market, it's a seller's market. So it's very important for you to have a real estate agent that understands the market, that understands your needs, so that when you get that house, you can present your offer and it will be attractive to the seller. Because the seller on one house, they might be getting 2 offers, they might be getting 3 offers. So you want to make sure that your offer stands out. And we're going to be explaining some of the ways on how a real estate agent or you yourself can make sure that your offer gets accepted. Because of course it's important to save time as well. A balanced market is a fair trade between both buyers and sellers. So all those things is demand and supply. If you understand economics a little bit, it's demand and supply. So the buyer's market now is 6 months and above. So 6 months and above, maybe that was when 2008, when there was a little bit of recession in the markets. Canada right now is booming, to be honest. We are way below the seller's market. We are way below maybe around 30 days right now, like I said. So it's you definitely have to get there. So if you see the property, don't wait, just grab it and know when to get ready. I mean, know which property you want and get it when you get it, when you see it. I also wanted to talk about the another issue or another question about the mortgage rates. The mortgage rates historically has been high, but right now we are low on the mortgage rates right now. I was checking today, I was seeing 2.49, 2.50 in some cases. My own mortgage, I think, is about 2.74. It really depends, but historically, there was a mortgage rate of 16%, 6%, as you can see in this graph. So right now, the mortgage rate is low. And this is because the government also is trying to encourage a lot of first-time buyers. They're trying to encourage a lot of people to go into home ownership. So they're trying really to balance the markets. They are trying, playing with the forces, the policies to encourage more first-time buyers. And we'll talk about this more in the upcoming slides. I wanted to go briefly into realtor.ca because when you're buying a house, your lender, whatever lender you're using, needs to show you the amortization schedule. So the amortization schedule for how you're going to make your payments, how long it's going to take, what is the time of your payments, all those things are what you have to ask your lender. So I'll give you a tool. This is realtor.ca. When you go to this website, you click on mortgage calculators and you go to payment calculator. So let's say we have a property that is 500,000, okay? And let's look at the different scenarios. This is scenario one, saying if I pay $25,000, how much will my this is the total of mortgage. This is the total mortgage required. If I'm putting the mortgage insurance, I don't know if all of you know this, but we have two major mortgage insurances in Canada. We have Genworth and we have CHMC. So the mortgage insurance is helping the lenders in case there is any defaults on your side. The mortgage insurance will kick in and they will pay the mortgage for you. So if you put 5% down, you're paying $19,000 in mortgage insurance. And I know this might be a little bit high, but like I said, when I bought my own first property, I could only afford the 5%. And to be honest, the earlier you get into this, the better. So it doesn't matter if you put in 5%. The most important thing is get into the market, get into it now. And it's not just me saying it from a sales perspective. It's because the longer it takes you to get into it, the more difficult it seems to be getting over the years. So you don't worry about the mortgage insurance, because if I'm paying $19,000 into my mortgage insurance, and I'm making $300,000 in 2 years or 3 years, say even if I make $100,000 in 2 years in this kind of markets, right? And I deduct my expenses, $19,000, I am still left with a chunk of money. Scenario two, so the more down payments you put in, the less your mortgage insurance. If you put 20% down, you don't pay any mortgage insurance. So anything between 5 and 20% is called high ratio mortgages, and conventional mortgages are 20% and above. So like I said, 25 years is the normal period if it's a amortization period if it's a high ratio mortgage. If it's a conventional mortgage, you can extend it to 30 years. So which means that your payment will be a little bit lesser because you're spreading it over a longer period of time. Now let's see if you're putting, say the mortgage rate is even 2.6, for example, in all of our scenarios, your mortgage amount is $2,238 for the first scenario, and your last scenario, 20% is 1,000, let's say for 1,600, right? So right now it's because this is more geared towards first-time buyers, I'm going to be clicking I am a first-time buyer scenario. So when I didn't click it, it was showing me the land transfer tax. The land transfer tax in Brampton, I think this was Brampton. The land transfer tax is $6,475. But if I'm a first-time buyer, then I'll be saving a rebate. The rebate is only for first-time buyers. If you're a second-time buyer, you will not get this rebate. So which means you're only paying $2,047 in your land transfer tax. Okay, so that goes also towards your cost. So now let's look at other closing costs of things that you needed. So you can go to this website, look at the different scenarios, look at your area, see the land transfer tax that is applicable in your area. In other areas like Habata, you don't have to pay any land transfer tax. So you need to put in all your scenarios for this software to calculate it the best way for you. So for 5% down, it's $25,000 that is needed. And another thing is, so on your mortgage insurance, you still have to pay your PST on your mortgage insurance. I know, right? But yeah, we still have to pay that. Your land transfer tax as a first-time buyer, and then your lawyer's fees $1,000, and your title insurance can be $500. So your title insurance will be paying to your lawyer at closing. So this is the total cash that is required. Now, what I wanted to show us is the amortization schedule, okay, for this kind of scenario. So with 5% down, the interest rate is on, what's the word? It's declining. So for the first month, for example, I'll see if I can find that here. So 2020, you're paying, total paid is, okay, the total amount you would have paid with your monthly payments. I think we can see the monthly payment as well over here somewhere. Let me just take a look. Let me close this for a while. Okay, so monthly expenses, yes. So your monthly expenses, your monthly payments with the interest rate is $2,238. So over 1 year, you would have paid this $26,852. The principal you're paying is this, and the interest you're paying in this is this. So if you think of this principal payments, I like to think about it as a savings account that I can't touch until a while. So until whether I sell my house or something, I can't touch this. So it's almost like a forced savings in a way. So that's what I wanted to show you. So feel free to come to this website. I hope this is very helpful to you guys. And now I'm going to go back to my PowerPoints. Okay. Now let's talk about financing. So mortgages can be very tough. And honestly, when clients call me and say, I need to buy a house, the first thing I'm asking them is, do you have your mortgage approved yet? It's okay if you come to me first, because then I can recommend or refer you to some mortgage brokers or go to the bank. But your conventional lenders, you can either go to the bank or you can go to your mortgage broker. The bank sometimes is good because you might have a relationship with your bank, whether you've been banking with them for 2 years, 3 years, whatever it is. They understand you, they know you, your pay stub is going into that bank account. So sometimes they are able to give you a better rate. But what I do ask is that you ask your lenders or mortgage brokers some questions, okay? You can ask them about the length of period. Okay, so well, I wrote some things down about some questions that you should be asking your lenders. Okay, so questions you should be asking your lenders, or ask them about whether it's open or closed mortgage. Open mortgage is a mortgage that you can, whether it's 25 years amortization period, you can decide to put a chunk of money down to reduce your principal payments, which in turn reduce your interest paid over a while. So you can decide to put a chunk of money into your principal payments, yearly. Some of the lenders, they have different offers on how to pay it without incurring any penalty. You should also consider fixed versus variable in terms of your interest rates, your amortization payments. And I think a question that is very, very important that I didn't know when I bought my first house was, what is the penalty if I do this to break my mortgage term? Your mortgage term can be 5 years. So every year you have a renewal period of maybe 3 years or 5 years. Typically, you can have 2 years too. So you have to think strategically and say, how long do I want to live in this house? Do I want to live in 2 years or 3 years? Is this my permanent house? Is this my first home that I'm just trying to get into the market, and I'll buy my dream house maybe 5 years down the line. So once you have this in this information in your mind, you can then go to your lender and say, I need a 3 years mortgage. Because what happens with some of the lenders is if you break your mortgage term, maybe in between, sometimes you might be paying 10,000. I've seen people pay $15,000 penalty fee because you break your mortgage. Sorry. So those are some of the questions. I think that's very important. That's a very important point of what you should be asking your lenders. There are other lenders that I won't go into. The syndicates, mortgage, private investors, funding companies. Private investors could be you and me. So let's say you have $50,000 in their bank accounts and you don't need it for the next 1 or 2 years. You can decide to lend it to somebody else and secure it against their mortgage. So the bank the bank or the first lender will always take the first position. In case there's anything, the market went down and the property depreciated, the bank will get their money first, followed by the private lenders. So private lenders, mostly we call them private investors as well. But because of the risk they are taking, they typically ask for more interest rates. So you might be looking at maybe $500 on $50,000, for example. So the person lending the money will be paying you $500 every month because of the additional risk they are taking. So that might be a kind of investment portfolio that you might want to branch into if you have the money sitting in your accounts. Some people ask me, Deborah, why will I want to do something like this? I have 15% interest rates in Nigeria. I don't want to invest in Canada. What I usually say is, Canada is more stable, right? I've invested money in Nigeria before, and because of the inflation, because of the exchange rates, I lost most of the value of that money in Nigeria. But bringing it over here, my kids are over here, my husband is over here, I can easily change the money into liquid cash if I wanted to. I can secure it against the mortgages. So that gives me more confidence that my money is safe and is secured. So that's the reason why you might want to consider investing your $50,000, $100,000 into do private lending. And I know a lot of people that are doing this full time and they are doing nothing else. So that's one of the ways you can make money in real estate. I know this is a first time buyer seminar, but I'm also giving tips along the way as I go in case there are other people watching and they're not first time buyers. Other things to consider. Shopping around is very, very important. But while you're shopping around, we have to be careful of the lenders pulling our credits, right? You should, maybe after the second or third time of shopping around, you should be able to make your decision. So you need to be able to protect who goes into your credits and does a hard pull. A hard pull stays on your credits. It could be 5 points for 6 months. So make sure you guide it. So if you're applying for a credit card, for example, that's a hard pull. If you're applying for a mortgage and you go to CIBC and then you go to RBC and then you go to all those things, they are all hard pull. So you can lose up to between 5 points to 25 points on your credit score. So it's very, very important you guard who goes into your credits. And also on this note, one of my clients yesterday, whether it's yesterday or day before this week, was applying for a mortgage, but so she gave credit information to a mortgage broker. First of all, when you're giving it to a mortgage broker, they need to provide you with a form and you need to give them the consent to go into your credit to pull it. They are not supposed to pull it without asking you. So this mortgage broker did not only pull one time, pulled second, third, fourth time. I saw like 5 hard pulls on our credit reports. And of course, our credits declined very, very drastically. So right now, she can't get a mortgage. She needs to wait for another 2 or 3 months or 6 months to get the points, to get the credit points back up. So you want to be careful of who goes into your credits while you're shopping around so that it doesn't impact your credit score credit rating when you are ready to buy. Down payments. When we're talking about down payments, your down payment should be in your account at least 3 months before closing, before buying the house. So they are trying to make sure that the money is not money laundry, right? They're trying to secure against money laundry. And also the government wants to make sure that you can afford it, because those are some of the guides that are in place to make sure that the system doesn't crash. Because in US, one of the things that caused recession the other time was because a lot of people were buying the house, they couldn't afford it, they were taking it from a credit card, they were taking it from all these lines of credits. And at the end of the day, when they didn't make so much money on it and everything was crashing down, it was easy for them to walk away. But imagine if there was 20% of your money in that property, you will still have to live somewhere. So you might decide to hang on to that property, right? So that's one of the things that they have put in place to safeguard our economy. And I think that's it could be very ethical at sometimes, but also it's for your own protection as well. On the issue of down payments, when you're bringing money from back home, right, to Canada, I just suggest to you guys to try to bring the money from banks to banks. So you're bringing it from Nigeria, I think it goes to the US, and then it comes to Canada. And this helps them to be able to verify the funds, again protecting against money laundering. They want to make sure that the money is clean and all. So you might need to, but the 3 months satisfaction still has to be there. The 3 months requirement still has to be satisfied. So they might be asking you, where did you get this money from? So be prepared to show them maybe proof of funds, whether it's you just sold your property or you just sold your house, or you are getting gifts from your parents too. So that brings me to the next point: gifts. You can get gifts mainly from your relatives. No interest payments, right? And no monthly payments. So sometimes they might ask you to fill a form and you're attesting that this money is interest free, and then you can use that. So with a gift, it doesn't have to stay in your account for 3 months. Okay. Another thing is your monthly income. So when they are considering your mortgage, right now the magic number is between your income, say it's $100,000 per annum, multiplied by 4, plus your down payment. So 100,000 multiplied by 4 is $400,000, plus your closing costs. Plus your down payments, excluding your closing costs. So sorry to complicate it, but so your annual income multiplied by 4 plus your down payment. So $400,000 plus, if you decided to now have $40,000 down payment, or you decide to have just 5%, which is $20,000. So that means your purchase price can be a max of $420,000. Now, some of the banks like national banks and other banks, I think CIBC as well, they do consider your child tax benefits. So if you are earning maybe $2,000 from your child tax benefits every year, and your children, the oldest is below, any of your kids are below, I think it's 11 years or 12 years, I need to double check, you can use that as your income. So if you're earning $2,000 for children below 12 years old, multiplied by 12, that's 24,000. You can then add that to your income, so $100,000. So that's 124,000 multiplied by 4. Some banks multiply by 4.5, but 4 is a safe number. Okay, so your monthly income is very, very important. Now, GDST, TDSD, gross debt ratio and total debt ratio. So these are indicators of whether you can afford the mortgage or not. So your TDS is taking into consideration of your existing debts compared to your income. So the ratio, I don't have a ratio offhand right now, but the banks know they have a ratio of what it has to be. So gross debt service, how much monthly payment compared to your income, and TDS is your total debt, so including your mortgage and other debts compared to your income. That's TDS. So There's a ratio that you have to satisfy before any lender can give the money to you. But also remember, some people would then say, okay, maybe I can only qualify for 450,000, but then on the back end, I can take a second mortgage of $50,000 and join it, so that then I can buy a house up to $500,000. So many people would do that, and there are benefits to doing that too, because in the amortization schedule we were checking before, realtor.ca. So if you put 20% down, first of all, you're saving on the mortgage insurance, right? So say you borrow $50,000, right? And you're paying $500 per month. So 500 multiplied by 12 is $6,000, right? So, but already you have saved nothing less than, if you're putting scenario 3, you're saving at least 11,900, right, by taking a second mortgage. So there are advantages. There are good debt and there are bad debt. So we just have to understand how to play with all these numbers and make sure we are still keeping more of this money into our pockets. So that's one advantage. And also, of course, your monthly payments will reduce. You can extend it to a period of 30 years because you're putting 20% down. So that's one of the things that some people are doing, some of the strategies where people can get into houses that it's a little bit reasonable. Now let's talk about credit score. Your credit score, for a bank, they prefer a credit score of nothing less than 680 points. If your credit score is lower, then sometimes they won't even look at you. If you're lucky, they look at you, your interest rates may be a little bit high. So it's very important to take care of your credit score, and we'll be talking about some of the things that impact your credit score a little bit later. And we've done realtor.ca, so I won't bother about that right now. Okay, so now factors affecting your credit rating. I think I got a question about this in one of the questions that was sent over to me. Your payment history affects your credit rating. So it affects it 35%. Outstanding balance on your credits it affects it up to 30%. Your credit history affects your credit rating for 15%. Credit type, whether having a variety of other lines of credits, is 10%, and inquiries is 10%. So credit history means that having the longer you have it, the better it is for everyone. So what I say to people is, as soon as you get to Canada, try to get your a credit card, and it's very important to have at least 2 credit cards. I would say 2 to 3 credit cards to have a good credit score. That will help them to be able to assess you and determine the kind of person you are, whether you're a spender or you're a saver. They'll be able to assess it. Outstanding ratios. So even if you have it shouldn't be more than 10%. So if every time there is a due payment on your credit card, the due amount should not be over 10%. Say you have a credit card of $40,000. Your balance shouldn't be more than 10%. That will keep your credit score in a very good state. Your credit history, so the longer you have it, the better. The payment history, I was trying to say, sorry, I was missing this up. The payments, hello? Oh, okay. Sorry. So the payment history is how long you're keeping your account zero. So if you buy something, say you buy a computer of $1,000, I suggest you go to your bank as the same day or before it's due and try to pay it off. So if you keep your balance consistently for $0, it will really help your credit score. So the idea is to have as low outstanding balance as possible and to try to run it as much as possible. Okay, so running it, buy most of our things on our credit card. So don't get a credit card and keep it under the bed. No, don't do that. They need to be able to assess whether you're a responsible person. So they need to know that if I'm giving you $10,000 or if I'm giving you $1 million mortgage, you are able to make your payments. So don't buy it, don't get your credit card and put under your pillow. You need to spend it and run it as much as possible, but keep the balance zero and just do your best. I know it's hard sometimes, but that's just what they're looking for. So I'm the messenger here. Credit type. Your credit type, you should not have just consumer debt. So whether it's just Walmart, have a combination of maybe Walmart, TD, your bank credit cards, auto line credit cards is auto line credits is also good on your credit report. So a combination of all or two or three gives you a better rating. So inquiries, we're talking about soft inquiries and hard inquiries. Do you know that sometimes even if you open your savings account, sometimes they would do a hard inquiry on you. So you have to be able to read all the policies of your bank before signing anything on the data later. Dotted space. They always say put anything on paper for black people. We always sign. We don't care. We read it. So please try to read and try, or at least ask them the questions about their policies to understand what you're signing. Try to avoid ad pull. So if you get a credit card, so I always tell people if you get a credit card in the mail, that's a soft check. They did a soft check on you. But if you are applying for your credit card, they are doing a hard check on you. Okay, potential employers are doing soft check on you. Pre-qualifications are soft check on you. Bank use soft check also to open your account. So soft check, you won't see it. It doesn't necessarily impact your credit score. Even if you checking your credit rating maybe once every 6 months is also a soft check on you. So when you're shopping for mortgage, it's important to maybe print your credit score and then take it to all the lenders and say, this is my credit score. What can you offer me? Before you give them the authority to go into your credits themselves. Now, how do I get down payments? 47:40 p.m. Thank you. How do I get down payment? So gifts, savings, RRSP, TFSA, credit cards, line of credits, and then the first time buyer incentive. I'm going through this a little bit fast because I think you guys know about this already. And I spoke briefly about this. So you can use your credit card and lines of credits because somebody asked me that question. But it affects your ratios. Remember, I was talking about TDS and GDS. It will affect your ratios compared to how much you are owing and how much you can afford. So just be careful that. So in order to be able to take lines of credit, sometimes you might need to be in a higher income bracket. Also, some banks, if you are in a high income bracket, I think of $180,000 and above. Some banks, such as RBC, I know they were offering that you don't need a down payment. Okay, they'll put everything together, so you don't need a down payment, but you need to have a high. You have to be in a high income bracket. First time buyer incentive. That's the new thing that just came out. It's first come, first serve, and the government is offering up to $1.25 billion dollars. That's the cap. So it's first come, first serve. So my take on this, let me discuss it first before I say what I think about this incentive. The government is sharing in the upside and downside of the property. You might ask me, when is there going to be a downside depreciation in the property? Say maybe you buy a property and it was dilapidated, and you think you were going to fix it, but then it further got deteriorated. Then maybe the property was bought for $200,000. Now it's further got depreciated and now it's worth $150,000. Then the government will still take part in the downside of the equity share. Okay. The payment has to be paid in full whenever you're paying the incentive back. If you get 10% for pre-construction, and then there is 5% for existing house, resale houses. So you need to pay the government back in full. There's no part payment. You can either pay them when you sell the property or after 25 years. The maximum is 25 years, and the property has to be insured. So you can't put 20% down, but technically you can put maybe 14 point something percent down, and then they give you the 5%, but it's not up to everything. Shouldn't be up to 20%. It has to be insured by either CHMC or the GenWatch that I was talking about. A lot of people are talking about whether it's a good policy or program, but the government is not intending it for everybody. They're just trying to cushion it a little bit. So it's not designed for your average purchase price home, especially here in GTA, where in Brampton, for example, it's very tough to get a house of $500,000 freehold, except it's an investor. It's a house that needs to be repaired. There's no $500,000 house in Brampton, unless if it's a condo. But the maximum purchase price for this incentive is $505,000 and 283. So 505,283, something like that, right? That's the maximum purchase price that you can get on this incentive. So my thoughts are, if this is going to help you to afford a house, I'll take advantage of it, right? When you buy the house, you don't need to necessarily sell it. So even after say you bought this house, the first house, you don't need to sell it to get into your next house. As long as the house is there, they are not going to come to torture you or say, give me my money back. No, they're not doing that. So you keep the house, you keep the money in your first house. If you refinance, then you might decide to pay them first, right? Pay them first, because you rather pay them when the shared equity is low, right? When the house is only appreciated maybe $50,000 or $100,000, than paying them when after 25 years that the property has risen to $1 million, right? We need to be smart, keeping more money in our pocket. So I will suggest that you pay them as soon as you can, but also if it's going to help you to get into home ownership, I think it's a fantastic program. You should take advantage of it. But also, it's not for everybody, because you have to be in the $100,000, $120,000 budget to really enjoy this benefits. Now, where to buy? These are some of the factors that we consider when we're buying a house. All those things you can go back and look at. So we look at places where things are favorable. So places like Kitchener, you can see enjoy the first-time buyer incentive. Amington is a good area, balanced area. Ottawa, some of the places like Edmonton, those places are a little bit farther from the GTA. But also, like I said, even places like Brampton and Mississauga. I was checking a house earlier. The house was 3-bedroom condo. The condo fee was around $300 per month, and the price of the home was $460,000. So they are not taking in account into your condo fees, because when you're applying for a mortgage, if, for example, your maximum affordability, the maximum house that you can afford is $500,000. If you are going to condo, because the condo has fees, now it's going to reduce your purchase price to maybe I'm not a mortgage broker, I'm just making out numbers, but maybe 460 or 450, right? That's the maximum purchase price, because you still have to be able to afford the monthly payments. But in terms of the first-time home buyer benefits, they don't care about the condo fee. They only care about the purchase price of the house, so which I think is very nice, because then you can still buy a condo house, get into it, whether you're investing it or you're buying it as your first home, use that money to afford a house, and then in the future you can have you can move into your dream house. Entry-level house, yes. So I wanted to discuss some of the houses that you can, as a first-time buyer, ways that you can enter into a house. It's buying pre-construction. So I have different ones available. So in GTA generally, when you're buying a house under pre-construction, they are always asking for 20% and above. because they want to safeguard their property. But other places like Barry, Bradford, and other places like that, sometimes they're asking for only 5% down, sometimes they're asking for only 10% down, right? And with this example of Barry that I was showing, their monthly, so they were asking for $25,000 total deposits, right? And so you pay 2,500 when you sign the contract, and then every month you'll be paying 1,250. This contract is not closing until 2023, right? The house is closing 2023, so at least you can try to also and afford this house while living in your in your rented property, rented space right now. Because what happens is at least you are entering into the market, and by 2023, which is like what, 3-4 years now, this house at least would have risen in value, and you would have paid this money, at the convenience of your home. And right now, people are not really looking into Barry, even though a lot of people are looking at it. And I'll let you read all the different reasons why Barry might be good for you. But a lot of people are not going there right now. And I remember 15-16 years ago when I came, nobody wanted to come to Brampton. But right now, Brampton seems to be the second home for almost everybody, right, to live. So right now people are not thinking about it. So you be futuristic, think about other places that you might be able to afford if you are not able to afford GTA. So that's a way that you can get into a home. But I'll let you pause this and read this later on what are the things that you have to try to consider when you're buying pre-constructions. Okay, and if you need more information about different places, you can talk to me later. Now let's talk about our power team. Our power team they are the people that are helping us to make these decisions. They are the people that we are relying on for information so that we can make the right decisions, educated decisions. So now we have mortgage brokers. Like I said, mortgage is one of the first things we have to consider before we buy a house, because once we know what we can afford, then we can determine what areas those houses are, right? What areas are affordable for us. So your mortgage brokers, ask them different questions, like I said, about what you need to know. Ask them about the different lenders they have. Some of them, they have relationship with the underwriters, and they are able to get the best deal for you, working for you. Mortgage brokers are not paid by banks, they pay based on the deal, so they are a little bit more flexible to shop around for you. Real estate agents, very, very important. They need to understand you and understand your needs and where you're coming from. And I think a real estate agent such as myself, Nigerian, that understands your language, understand everything, that as a new immigrant, will be able to understand your needs and better service you or assist you on the buying process. So you need to ask them, how many houses are you selling? What are the areas you cover? Can I see how many days? If you see a property that you like, how long has this house been on the market for? What is going on in the market? They should be able to tell you what is going on in the market and tell you a little bit more about the things that you're considering. They should be able to give you pointers when you're going into a house. Although when walking to a house, we're not supposed to say, oh, I really like this house. It's not our personal opinion. It's you living the house, but we should be able to tell you, one or two things that you should consider. Now, insurance agents, you need the insurance when you're buying a house. I think insurance such as critical illness insurance is very important, because if in case something happens to you as the breadwinner of your family, say whether you had an accident or something happened to you, the insurance companies will start paying your mortgage for you. So I think that's really neat. It could cost you maybe $50. It doesn't cost a lot of money. I think that's an important insurance to have. But the insurance now on your property, excuse, okay, thank you. The insurance on your property does almost the same thing as a life insurance, because the insurance on your property might say in case of death or anything, they will pay out the principal amount left on the property. But remember, your principal amount is always decreasing, versus if you have a life insurance, then it's not based on the principal amount left. It's based on whatever you are originally insured for. And you're paying the same amount over here and here, but here you might decide to get more depending on how long you live, you stay around. Home inspectors, you can get referrals from your mortgage agents or your real estate agents, lawyers. You can also get referrals. We talk about deposits. Deposits is very important. So the money that you want to use to buy a house has to be liquid. So if you remember, I was telling you it's a seller's market right now in the GTA. You want to make sure once you like the house, you make the offers. Once your offer is accepted, usually within 24 hours, you have to drop a deposit. The deposit could be 1% or to 2% of the price of the home. So if you buy a house of $700,000, you might be paying maybe $10,000 deposits to the seller's office, to the seller's agents. The deposit has to be liquid, so you have to be able to go there within 24 hours and drop, your deposits. Closing costs we already covered. Appraisals, usually the bank would take the appraiser, the purchase price as an appraiser. Sometimes they might order their own independent appraiser on the house, but they usually cover for that. So I wanted to leave more rooms for question. So if you have more question, I usually cover Mississauga, Toronto, Brampton, GTA in general. So feel free to reach out to me, and I'll be more than willing to assist you. So is there any question that we have right now, Sam? Like I said, if you're using your bank, sometimes they might give you a better rates because you've been banking with them, and your pay stub, probably everything goes in there. So, but a mortgage broker sometimes, especially if you have a complicated deal, they are able to shop around better for you. So if you are in the high income brackets, you don't have time, I would say go to your bank. If you have, maybe, you're trying to get the best rates, and also you're trying to look for more flexibility, right, in terms of penalties, in terms of the mortgage terms, your interest rates, I would say look for a mortgage broker. A good thing about a mortgage broker is also that once they pull your credits once, they're able to take that same credit to different banks, and the banks will then honor that's credit reports, right? But if you take your report to the bank, when they need to give you the approval, they will still pull your credits. But if it's coming from a mortgage broker, then they don't have to pull your credit. So they only pull your credits once. So that's the short answer to that. Mhm. 680 points.
Africa rapper number one, yo. Am I a microphone magician, oh? Everybody put on kaitewiya. Am I a woman, oh? Africa rapper number one, Africa rapper number one. Am I a microphone magician, oh? Everybody put on kaitewiya.
Yes, and they say I'm the best, I'm on top of the rest, cash is clear what I do to the list, rappers are vexed, chasing me with a Vespa, some not kicking a Pepsi, not a threat, I'm a jet, flyer than IRS, helicopter flow type.
Yeah. Thank you. Thank you. Thank you. Bye.
Africa rapper number one, yo. Emma, your microphone magician, oh. Everybody put on kaitewiya.
Okay, thank you very much, Deborah Ojo, for your time. We've definitely learned a lot. Thank you very much, Sam, for handling the technicalities today. Thank you to our subscribers for staying on with us and for your questions. This is the end of the program, but we do have a couple of programs lined up starting from later this month, details of which will be shared with you on our platform. So just in case you don't subscribe, I implore you to subscribe to our Telegram channel for now. The details will be shared. So do join us and keep that page open as we're sharing more information. So on behalf of the technical team, thank you very much. And signing out. See you next time.
Africa rapper number one, yo. Emma, your microphone magician, oh. Everybody put on kaitewiya. Emma, you get woman, oh. Africa rapper number one, Africa rapper number one. Emma, your microphone.